Welcome, everyone. Just going to give people a few seconds to get logged in, but couldn't think of a more exciting way to wrap up our week with a lunch and learn. So hopefully everyone has a meal on this Friday before we head into the weekend. Exciting about what this lunch and learn brings us, but give everyone a few seconds to kind of get squared away, get maybe their drinks open, their meal open, so you can learn along with us. Okay. For those who don't know me, I'm Brenna Nath. I'm the director of HW Plus and events here at HW Media, and I'm your host for today's Lunch and Learn, which is focused on fraud, risk, and qualities, and the hazards to watch for in gaining purchase market share. So something about this lunch and learn that I would emphasize for anyone who's been in this business for a little bit, especially this year, we have a huge emphasis on growth. You're growing your market share, growing your pipeline, growing your business, and trying to find the strategic ways to maximize your pipeline. But something that's very critical in this whole world of growth and very vital to your success as you're building that strategy, it has to be centered around risk, mitigation, fraud management, and QC guidelines. And these are critical areas for the healthier business and should be top of mind as really you go into the rest of 2022 and beyond, since we're almost in 2023, if you can believe it or not. So this Lunch and Learn today, which we're excited to host on a Friday, is sponsored by QC Ally, who's the official enterprise loan quality partner here at HousingWire. And we're going to unpack the latest insights on the hazards to watch for when it comes to growing your share of the market. So going back to that first point, if we're all in growth mode, so what are some of the other things and risks that you need to be paying attention to? I'm super excited to introduce our list of panelists that we have with us today. So first, we have Faith Schwartz. She's the founder and CEO at Housing Finance Strategies. Thanks so much, Faith, for joining us.
Great to be here.
And then next, of course, and then next we have Mike Kelleher. He's the Vice President of Sales at QC Ally. Mike, welcome to the Lunch and Learn.
Hello, welcome. Thank you for the opportunity.
And then lastly, we have Jennifer Menard, who's the Senior Director of Product Management and Mortgage Solutions at First American Data and Analytics. Jennifer, so excited to have you with us.
Having me.
So before we jump into the insights that these three panelists bring, I want to go over a few housekeeping items and logistics so everyone can feel prepared and equipped for what you can expect during this presentation. The main thing being, feel free below. I think at this point, we're all pretty familiar with Zoom, so you should see a Q&A button below along with the chat feature. Feel free to submit questions at any time during this Lunch and Learn. Our panelists and me and our team will be monitoring that chat. So if you have any questions throughout, feel free to drop them in and we'll be answering questions throughout the Lunch and Learn. We want to make this a collaborative conversation, so feel free to drop your questions below. The second half of that is that we will be sending this Lunch and Learn on demand to everyone who registered. So if you want to watch it again later, take more thorough notes, or go back and find a quote, feel free to check your email for an on-demand version of this in a few days. Or if you miss, your email gets full or something like that, I know we all have quite the full inbox, feel free to go to the Knowledge Center on housingwire.com and you can find a copy of the Lunch and Learn there as well. Without further ado, let's go ahead and jump into the webinar. Or the Lunch and Learn. I couldn't think of a better place to start than this question for Faith that really just sets the stage for this discussion we'll be talking about today, which is, Faith, can you provide a 1,000-foot view of the housing industry right now and how that ties to risk, kind of setting that foundation for this discussion?
Sure, I'm happy to, Brenna, and thanks so much to HousingWire and QC Ally. It's really fun to be here with you all today. And I'm looking forward to Jennifer and Michael's comments as well. You know, the market, I've been around a lot of cycles in the mortgage market, and we're in a particularly tricky one, as you know. And I'm going to talk about three things I think that keep driving kind of risk into the market and that any originator or correspondent lender needs to be thinking about. First, we have extraordinary rate and market volatility right now. Now that's going to settle down when the Federal Reserve kind of finalizes settling up where their rate rises are happening. And once that kind of hits that normal balance, most economists suggest that we'll see a lot less volatility. But because of that volatility, we've had very dramatic balance sheet problems for banks and loan servicers, and we've had a shrinking in the mortgage market coming off an historic $4 trillion plus market. So, you know, the trend is we put a lot through during a pandemic of mortgages that now we're kind of absorbing and kind of reviewing the post-production of what's happened. And then we're trying to reset our companies, our production goals, our purchase market goals in a much shrinking market. We also have seen a dominance of the IMBs in the market, which is another trend. It's never been higher. 10 years ago, the banks dominated Ginnie Mae servicing. Today, it's in the 90s that percentiles that the IMBs, independent mortgage bankers, are now dominating FHA and VA business, and the banks are shrinking their MSRs in the business. Why is that important? It's important because we're seeing a shift in the marketplace, and that means our counterparties, our investors, are thinking differently about who their counterparties are. We just saw Ginnie Mae and FHFA put out counterparty eligibility requirements because their counterparties are not dominated by the banks. It's actually independent mortgage bankers now. So that's just an example. To follow up on that, actually, we just saw Wells Fargo also announce a retrenchment of coming out of the correspondent business. So a lot of change going on right now. So why do we care? Well, we care about financial stability, right? We have a high cost to originate. We have weaker balance sheets in light of the significant decrease in volumes and then just higher fixed costs. Per the MBA, we're at record highs at $10,000 or more to originate a loan. They just showed a loss of 5 basis points for the average of the IMBs last quarter. So what does that really mean? It means that we're going to start seeing peak scrutiny on how the loans are being originated, how they're being processed, underwritten, and closed. The investors are a little bit behind the scene, and we'll talk about that in a minute, the government side of that. But we're going to see a lot of attention on how a loan's been originated and processed and what kind of data has been used, how the accuracy and the input, how does it match the legal documents. We're going to see more attention on the audit process of individual loans because we're in a tougher marketplace. And just like the Great Recession, there's a lot of scrutiny after a lot of volume has gone through the business. So I think we're in a transitional period where we're going to look for manufacturing process flaws, increased incidences of fraud. And it's a tough market, right? We're cut almost in half. Some companies are 60% off. And the market slowdown on the rapid rise of rates of 300 basis points plus in a very short period of time has just caught the market a little flat-footed. Doesn't have to mean it's a horrible situation, but it's just the realities we're all dealing with. And we're seeing it through announcements of some companies not being able to stay in business or looking to merge, et cetera, or some layoffs. So we've got to slow down. We're going to have to look hard at data and fraud management because there are higher incidences of first payment defaults. We are also dealing with process of everything we put through the system. The 4 trillion plus that we put through the system in the last 2 years are now just coming under quality control and due diligence in some investor markets. So, big picture, a little more risk into the market. There's less volume, a little harder on companies to deal with. So whenever you get a repurchase request from in this kind of situation, you want to be really thoughtful about how you're originating, buying, or closing mortgages in this environment for your kind of institution.
That's a good point too, when it comes to, the cyclical market that I think we all live in. I haven't been in the industry too long. I've been in it for 10 years and went through a couple market cycles myself. I joined HousingWire right after the financial crisis as things have shifted. The second half of the question that I would ask is, even in the 10 years that I've been watching things, regulation policy has shifted drastically. And I think what the regulators are watching is something that's not only top of mind for lenders, but it's also top of mind because it is shifting constantly with what's currently happening, tech things that are happening and so forth. So from a lender's perspective, can you also touch on, and you have a great background in this, what are the big picture topics that the regulators are kind of looking at right now that a lender should be mindful of in this particular situation? So when it comes to risk and QC.
Sure, of course. Well, listen, if you think about it, so you joined right past the last Great Recession. There was a lot more to deal with, a lot less good tech. People weren't even looking at documents, as we all know. We had some really poor production and underwritten products and high risk, just even on the quality of the production. Today, that's not the case. Things have been well underwritten. It's not like we've had a reckless market, which because a lot of regulation was put into place through Dodd-Frank post-crisis in 2008. But dial forward, what we have today is an administration that has a housing agenda like no other. I've never seen an administration so ingrained in housing policy. Have you ever seen FHA or HUD be on the main agenda on housing from the White House? It's highly unusual. So we have the PAVE initiative on appraisal bias, and that includes data, and it includes thinking differently about how to evaluate things on an objective basis and not a subjective basis to get opinions of value. You have climate change issues, which have been distributed to all agencies, and all agencies are looking hard at how that's impacting underserved markets, how it's impacting cities, coastal headlines, and then what the risk is, and then how we're dealing with it, and then even bringing it back to the consumer to disclose it. That's going on right now. And it's a big high priority for many of the big housing agencies. We certainly have fair lending and fair servicing and fair modification. So we've just been through a pandemic, and we thought 8 million people could have gone through foreclosure if they were displaced. But because of the work of the government and the industry, we have much lower delinquencies now. The forbearances worked well. However, those that have to go through and get modification resources or perhaps have to still go to foreclosure will be scrutinized 100%. Every loan that goes to foreclosure will have a review by some agencies, no doubt. And so, you know, risks, are they there? Sure. There's been a lot of changes, a lot of process change, a lot of requirements from the different housing agencies on how to modify a loan and avoid a foreclosure if possible. So again, the whole administration and message to the regulators and to the agencies is do what you can for every borrower to avoid a foreclosure. Be equitable, make sure that there's no fair lending problems. Why does that matter? Well, it does matter. It just matters on audits. It matters to know, what is HMDA telling you? How many loans have been rejected that should have been made? There's that. Another, I'll just give you 2 more points and finish. The GSEs a while back had an Office of Inspector General highlight that they had a lapse in the seller servicer oversight. So expect a heightened attention from the GSEs to the seller servicers, their originators, their servicers, for audits and oversight that maybe was lax through the big process issues we just had. So they're playing catch up on, you know, all that volume that came through the system. We're also seeing, you know, higher risk, some push toward making more loans work that are non-traditional, that may or may not be higher risk. I think the intention is that it's not higher risk. Regardless of that, we're seeing, you know, they're going to look at every loan that gets made to make sure it was properly made. So I think we're going to see a big shift from the GSEs to quality assurance, manufacturing quality of the loan. Do what you say you do, make sure your documents say what you do. So attention to your systems, your tech, and everything are going to be very important. The last comment I'll make is, and we experienced this with the Great Recession, but the power of the False Claims Act shouldn't be understated. It is very powerful that a federal government agency can make you repurchase loans anytime they want if you have any material manufacturing problem, even if it wasn't intentional and it really it's not necessarily part of the underwriting, and it's just it's an old regulation that is in place, and HUD certainly took advantage of that through the last recession. And I've seen no indication they're going to do that, but that is on the books, and the Justice Department and HUD can do that anytime. So that is quality assurance. That is making sure your loans are well documented, and that the data that you use is good data, and it's not cut and pasted or too many human errors. So I think that's that investor, you know, investors want certainty and they want good information. So the more companies can, kind of end to end originate and use that data and push it all the way through instead of having bank statements versus something else. And then they take, a third party different report that's not, it's inefficient. And if it doesn't match the docs, and, I think there's risk in the system. So I think everyone just has to pay a lot of attention because it's very expensive to buy back loans.
Yeah, well, and an interesting point there that I think Michael and Mike and Jennifer can weigh in on is right now in this market, you mentioned, we $4 trillion at kind of the housing market has seen over the last few years. We're shifting. We keep talking about this purchase-driven market in this decision to still grow and going back to that growth mindset. There's also a lot of diversification of products with this growth. So we were having to navigate into different maybe lines of business, different product offerings that we weren't offering before, lenders weren't looking at before. And with this diversification of products comes what we're talking about here. So, Faith, you mentioned that, look at things closely in the origination process. So not only are lenders having to look at things closely, there's this new set of variables and product rules that are now trying to introduce into their option desk for borrowers who are coming into the door to maybe get them into HELOCs, get them into different second homes, anything like that. And I think Jennifer and Mike can weigh in on that, but maybe Mike, I'll start with you, in a purchase market with this diversification of products, what does that mean for fraud, loan quality, audits, that sort of thing?
A great question and great insight, Faith. And I want to thank you again for the opportunity to be here. And we at QC Ally are really appreciative of being the official sponsor of Enterprise Loan Quality. I say that because it's our big rebranding week. So this is an excellent exclamation mark here on a Friday of the big rebrand. As far as the purchase market goes, or when you're watching the mortgage cycle, we tend to see changes in fraud and risk when you move from refinance to purchase. For instance, mortgage fraud typically rises in a purchase environment. There's a lot of buzz and discussion that fraud risk is increasing right now. And is why? Well, the movement from refinance to the purchase market is due to rising interest rates, which translates to a lesser pool of borrowers who qualify. We're actually at the lowest level of credit availability since mid-2021. So to maintain the same income levels and of those higher volume years, some players in the market commit fraud so that borrowers who no longer can qualify for the home they wanted to purchase would be able to obtain the loan. And that can be done through maybe stealing an identity or fabricating parts of the loan, or we're even seeing in some cases the entire loan process or the entire documentation is fabricated. So I think our theme is as we move away from refi, we're going to see more creative products, which are going to help expand home ownership. And some of those will be lower document loans, which means the fraud and the risk of fraud increases because the more documents you have, the better chance you have of catching the fraudsters. I don't know if you've ever seen a 30-year-old person with a 55 plus bank account, for example. If the fraudster had just provided the verification of deposit, the red flag may not have picked up on. And that goes back to loan quality. So it's important that everybody in the organization is aware of those current fraud trends and risks, and they should be able to identify them and detect fraud. Many times we say using the common sense approach to identify and detect fraud or other issues, it's possible if people are properly trained. So some fraud schemes are complicated and hard to pick up on and hard to catch, but most are detectable. So it's accurately identifying and classifying defects that can strengthen the lender's entire QC program. It can improve loan quality, and it can drive change within the organization.
Yeah. And then Jennifer, the part that I thought kind of fits is, you have such a good bird's eye view when it comes to the broad trends that's happening in the fraud space. So, how have you watched, I keep using that word, we're in a, cyclical industry. So that specifically kind of goes to what are the trends that are lenders need to be paying attention to right now, and what is the risk of them not paying attention to these broad trends, trying to define what makes this 2022 purchase season different compared to someone who's like, I did, Faith mentioned years ago, right after the financial crisis, what things looked like then. This is a very different market than what type of market we had then. So what are those specific things and broader trends? So I say specific and broad at the same time, but you know what I kind of mean there, of the trends that people are seeing, what you're seeing, and then why they need to be paying attention to it and the risks associated there.
Yeah, so at First American, we have a flagship product called Fraud Guard, where we do track mortgage originations through our system. And there's 6 key risk categories that we are tracking that cover agency lists, so matching GSE list or other investor lists, undisclosed liabilities, employment income, occupancy, identity, property flipping, and valuation issues. So those are the key 6 areas. And so what we're seeing so far this year kind of aligns with what Michael was saying. We've really seen a tick upwards, an increase in kind of the agency list matching. So parties that, are on an in some fashion with at least 85 to 90% confidence matching. So that's key, right? So matching the loan participants to those industry lists to kind of check to see where those conflict of interest might be, or perhaps if they are flagged ineligible. The other thing I wanted to mention is that we are seeing occupancy issues on the rise as well. It's been consistent this year, and we will continue to watch that in the future. Now, on the other hand, employment and income remains very low. At this time, I think that has a lot to do with the re-verification of employment and income right up until closing. I think that has helped kind of keep that under control. As well as undisclosed liabilities. So we typically see undisclosed liabilities more of an issue in refinance than in purchase market. And so those trends are consistent in Fraud Guard as well. And as far as identity issues go, we've seen a slight uptick in the last 6 months too. It's not significant, it's probably a point, but it's definitely something we'll continue to watch. So I would say by not paying attention to those risks associated to those potential excluded parties, lenders might find themselves with unsaleable loans or loans that are open to high risk or default.
And Faith, I just go back to you. I mean, we did talk about all of the cycles. So is there anything there that you maybe add to that discussion?
Well, listen, no one wants to repurchase loans, right? That is hard. You usually in dispute for months with the investor, whether it's a GSE, a private investor, et cetera. But I would just say, when you have to repurchase and then resell those loans, you sometimes lose 30 or 40 cents on the dollar, or it becomes unsaleable. And so think of the average loan balance and then go higher, because you know what? We have a lot of $500,000 loans. So think of 30% of that. All of a sudden, that's very hard for independent mortgage bankers, even banks, to have to keep that on your balance sheet, market to market, and get rid of it in a big pool of non-performing assets, or, a loan that isn't qualified for an agency. It has to be refinanced or something. So it's very expensive, and I think people underestimate the importance of that issue. And I've seen, companies kind of get caught up, warehouse lines get caught up with, some poor performers, not because they intentionally did it, but because something happened in fraud or something else. So it's important, this whole subject of getting it right.
Yeah, very, very much so. And maybe the follow-up question I'd go back to you, Jennifer, which is on that same train of thought, which is, do you think lenders have fraud prevention as top of mind right now? Knowing this current state, how can they make it a higher priority? We've just stressed kind of where things are, but I mean, to the lenders who are even sitting here on this lunch and learn, how can they shift kind of going forward, or make sure that it is a priority, or they're watching it closely?
Yeah, with rising rates and really less favorable economic indicators, obviously the projections for those home sales and refinances have decreased, but there is an extra consideration to the margin and cost to produce that loan. So lenders will be looking for avenues to optimize staff, processing, and technology and automation. So really the task is focusing on quality of the loan lender's profile as opposed to the quantity of loans originated.
Yeah, great points there. And then kind of shifting gears a little bit, but still in that same world, Mike would love to hear, and then maybe even Faith has some like stories here that she could add to it. But as we're shifting, away from this refi market, I think one interesting part of this discussion is fair lending and how loan quality assists in fair lending and ensuring everyone has access to home ownership, how that plays a variable in this discussion. Right now, we've been talking about kind of the risk and fraud, but I do think there's that fair lending element in this discussion that we should address. Can you kind of touch on that some?
Yeah, I think it's important to recognize the housing industry's focus isn't really about the mortgage loan. It should be about home ownership. Some of our great sales leaders always say nobody goes out and says, I want to get a mortgage. They say, I want to get a home. And fair lending is part of the audit reviews. And a QC expert can be that line of defense in watching for any type of fair lending issue. They can protect the brand. And it's about fast identification of fair lending issues that'll result in addressing any of the issues, ensuring the lender's practices are compliant, and then ultimately protecting the consumer. It's wild to think about it, but in 2022, we've heard of, in conversation logs, we've heard of people saying, like, are you expecting? Or emailing an appraiser to watch your back when they go into an area, so into a given location. Fair lending audits can quickly identify and stop that type of behavior. And in turn, it builds long-term trust to the entire ecosystem, so it can ensure that we're expanding home ownership to everybody fairly.
Yeah. And Faith, any color there?
Well, yeah, I mean, I'm a big fair lending advocate. I believe every company should have the consumer at the center of their universe, whether they're originating, servicing, quality controlling, whatever their line of business is, because if you kind of do the right thing, if you take things authentically, if you look for the quality versus a predatory pricing practice or targeting, you'll get good outcomes and you'll have a healthy business. So it's fair lending is important to me personally and professionally. We run a business on that kind of effort as well. I would just say, in particular, on the appraisal side, the more you can think about setting up a proactive validation of consideration of value. If you're seeing someone in a minority census tract, Freddie Mac's report showed great examples of this. Having auditable, traceable activity around things that might be undervalued by a certain appraiser on a regular basis because it's in a certain census tract and it might track to be a high minority census tract. Having the ability to track yourselves as lenders and make sure you're doing enough to, push back and say, can we get a second thought of there? Let me do a desk review on this. It seems off. It's a high price neighborhood. Why are we $200,000 under? So, as we've seen supposedly anecdotal evidence, but there are other, cases where we're seeing better information, better scrutiny, and better processes and guardrails in the system to keep everyone kind of on the right track is very important. And I can assure you that's what the government will be looking at over the next couple of years. This is a hot topic. And to me, source data helps you get to the right answers. The scrutiny to always double check, just have good processes and systems and partners that help you do it. Good products like Jennifer and Michael have, because that'll help you kind of stay above the fray on some of these issues.
Mm-hmm. In that, and that it kind of leads right into what I think Mike, you can weigh in on is we keep talking about this shift. We're now gone are the days of the refi driven market. We're now in a purchase driven market. Faith just commented on what you can do to watch your origination in your pipeline. Is there more that you could dive into there when it comes to what regulators and investors are saying that people should be mindful of in this shift to a purchase driven market? And then maybe even I'll probably toss it over to Jennifer afterwards to even talk about some of the trends that she's seeing that are unique to this market. So the fact that we are in a low inventory market, the fact that we are that mortgage rates are shifting, and what makes this market unique because it is a different type of shift. But maybe starting with you, Mike, on that idea of regulators, investors, and what people should be mindful of.
Yeah, and as we indicated, the industry has noticed that fraud is up in the business overall. And I was going to say, Jennifer touched on some of the indicators of that, or where to look. And we can expect GSEs and investors to be looking more closely at loans originated during this time period. And Faith just touched on it quite a bit. And so we're hearing about potential loan default and buybacks cascading. Pre and post loan quality assurances and assurance checks, I should say, on the data and the processes like Faith was mentioning, will be helpful in keeping the defect rates lower, and it will minimize repurchase risks from the investors. The whole industry will be reviewing this shift in business practices.
Yeah. Jennifer, anything that you would add there when it comes to, how the state of the industry plays into this, lower inventory, higher rates, staff, margins, that type of thing?
Yeah, so lenders, really, I think we've kind of touched on it already, but I think that finding solutions that assist in streamlining their loan approval process will, of course, help originate a quality loan with a limited amount of time, and and attract highly sought after buyers and realtors. So utilizing technology to assist the staff in their workday is key in remaining competitive.
Yeah. And for all of you, what would those best practices look like? So knowing, you guys mentioned technology, you mentioned, the way you're watching pipeline. Can you dive into, and maybe starting with you, Mike, what are those best practices that lenders should have in mind to reduce risk in this market? And maybe everyone can kind of chime in there.
Yeah, as far as with technology and people.
Yeah, whichever direction. I think when it comes to best practices that are helpful to be watching, so whether it's people, whether it's to the tech stack that you need to have implemented, things that will help create that management of that risk.
Well, we think tech-enabled partnerships are extremely important. I've come from a background of spending a decade in the technology side of mortgages, and in the mortgage life cycle, I've never seen a particular part of it where the human aspect is so important. We believe the best loan quality is built around the partnerships of technology with human assistance. These trained experts in this space know what to look for based on a rapidly changing regulatory and investor environment. But the technology becomes the tool in the toolkit for speed, for efficiency, for data. And at the same time, the technology is providing more and more transparency in areas that didn't exist before. So I think both work in concert with checks and balances to protect the lender and the consumer as well.
Jennifer, anything that you'd add there?
Yeah, and I think with the downward market where lenders are, having to manage their workforces and costs, there could be a scenario where bad actors try to capitalize on that disconnect. So I think it would behoove lenders to look at tools that combine both native or expert and artificial intelligence models that will both be predictive as well as protective. And to Michael's point, transparency is key. There's a level of partnership there between, there's a partnership there where you have to kind of close those feedback loops when things are found or you are seeing certain trends. You want to kind of communicate and make your partners aware of those things.
Yeah. I know, Faith, you do bring such a good history in this space to this discussion. So any best practices that you would add that maybe have been around for a while, any best practices that you think are unique to this market that people should know?
I guess I would just say, I mean, again, as we were saying earlier, Jennifer, we're seeing some of the same kind of things that we've seen 10 years ago. I think what I would consider sharing is it's really easy to try to lay off your overhead, your infrastructure cares about risk or quality assurance, but they're going to be really the armor you have to survive and power through a tough market. These things work in cycles, repurchases work in cycles, and that $4 trillion going through the process of being reviewed and updated, was done during a pandemic when everyone was remote and at home. So you've got that issue behind you, and you're probably going to have to see what that looks like from the investor's point of view over the next year or so. And then today you have people who are just desperate to make loans, right? Because if they don't, they can't keep their companies, making money and active in the market. So you've kind of got a rough situation of trying to stay in a good business. My recommendation is continue to invest in your tech. Keep your strategic risk people on board to make sure you power through strong auditing. Make sure your counterparties, you don't start to loosen up on things that are always valuable to you. And work with partners like QC Ally and First American to make sure you're leveraging the smart tools who look at data and can quickly help you with an adverse audit, because all of the investors will be scrutinizing the mortgages for several years now, based on the last couple of years and even this year. That's my 2 cents.
Yeah. Well, and I know a big theme of this market right now is maximizing your tech stack. So looking at the technology that you have, we did get a question in that really just asked, what tools do you recommend being used in the toolbox to help with these best practices? So, you have FradCard, but like what other things they're asking are out there? And maybe Mike, Jennifer, all three of you could really weigh in on that of how should you look at your tech stack, how maybe even to help parse that question down is the variables or the key parts and qualities they should be looking at in the technology for what the technology needs to address. So kind of thinking about, we just listed all these best practices. So what tools do they need to have for it in order to be prepared? Maybe Mike, starting with you.
Well, you need tech-enabled auditing software that we believe promotes reporting throughout the entire life cycle of a loan. So if you have the same reporting in pre-fund and post-close and servicing, it allows you to automate, like we talked about, with the efficiencies and speed to get those reports to the different departments to help deal with the volatility and the change in market. Another area is OCR and having the ability to be able to efficiently look at documents faster. And all of this needs to be done with experts, whether they're in-house and your experts are doing it on the software pre-fund or post-close. You have a tech-enabled group that has worked with the same software for years, because you need to ensure you have a QC team that understands the trends, can identify the trends with the new products, the higher risks, and understands how their technology can be used to facilitate it. But again, it goes back to that human aspect and the humans able to understand and see these trends and then use the software as a tool in their toolkit.
Yeah, Jennifer, any extra thoughts there?
Yeah, and I agree that automation is key. Fraud tools that really can segregate loans within the process, just, being very targeted about the risk, understanding which are high risk loans that need further scrutiny, but just as important, identifying low risk loans too, that can kind of move through the process a little bit quicker. Thinking about tools that are also have kind of smart analytics that are able to pivot between new market trends or a shift in the market, things that are very fresh and updated and not something that's stale or is looking at something that happened, last year or the last season. So I think, model governance, understanding who your partner is, kind of showing the data results, keeping the false positives low, are all key to really identifying quality loans and keeping the risk low.
Yeah.
The other key piece is, as somebody who's seen the whole mortgage cycle, often as you get further away from the sale, the available resources and development to the lender become less and less. So you want a tech-enabled partner that has software that's easy for the department to be able to use and customize to their workflow without needing the resources that maybe never come.
Yeah. That's a great follow-up, because the question I was going to dive into, which you kind of answered there, was like even maximizing that tech stack. So having what you have, but making sure that you're using it to its full capabilities. I think resources, everyone's looking at the resources they have available to them in order to make sure that they are hitting the core things that they need to in their business right now, especially when we're looking at margins and how this cycle looks. Faith, is there anything that you would add into that discussion?
Yeah, I think, I've learned a lot about data aggregators and asset reporting. I had some affiliation with FormFree. I'm not affiliated anymore, but I learned a lot working with them, and they have a great tool, the asset report, which really picks up the kind of source of funds to close and verification process all the way to closing. There are many other companies that do that too. So, there's a good group of companies that now provide, you don't need 9 pages, 3 months in a row of bank statements to fill a file. And by the way, those reports all show you, like an underwriter couldn't look at that in the asset report and come up with the same answers, because it would take a lot of manual calculations. So it's kind of using smart data off of borrower credentialed source data with no third party in the middle of it. And I always say that because that's why it helps mitigate fraud. And I spoke to someone before this. I poked around and say, well, what are you seeing in your company? And they said, well, a lot of income and asset fraud. I thought to myself, you're only seeing that because you're not hooked into an automated asset report. It's not very expensive. So it's certainly not expensive to be in the middle of a loan origination process. Is high at $10,000 or more to originate. And this is a very, reasonably priced process that can give you great certainty, even rep and warrant relief from the agencies. It's still not universally used across the business. We're still in paper on a lot of things. It's the appraiser side has a lot of similar kind of antiquated efforts, when there's really much better tech around now for data, property data, as well as 3D scanning. So I only say that because it really would cut down on, efficiencies, and it would also improve the fraud and bias issues.
Great addition to that tech stack, looking at it analytically. Got a good question in from Clayton, where he's kind of going back to the specific housing market that we have right now. And so he kind of says, we're arguably in an ebb period right now in the housing, opposed to what we've been seeing the past few years, is record-setting volumes, people continuously breaking their top volume records that they've had in the past. So now that we're not in that high volume flow period anymore that we saw last year, how do quality control and compliance, two big themes that we're talking about here, how do quality and compliance risks differ in different stages of the housing market? So I know we've throughout this discussion just talked about, I know Jennifer weighed in when it comes to what makes this market unique, especially where inventory and all of these things stand. So let's talk about it in the scope of quality control and compliance. And maybe, Mike, if you want to start us out there.
Well, the different cycles that we look at are pre-funding. And as you have more marketing out there on the sales side, many lenders like to control the pre-funding because there is a speed element there on the day before the purchase. And as departments are being spread thin, we do encourage lenders to take control of their pre-funding, and we give them the technology and the guidance and the mentorship and training to be able to handle that and have the competency and, most importantly, the accuracy that can build trust in the system. And then when it goes to the post-close part of the process, where you have more time to look at the file, having the right tech-enabled partner to provide the level of service and know and have the experience to know what the trends are in risk and fraud is very important, all the way through servicing. So we see the pre-fund is an area where lenders will want and have more control, and the post-close is where having a partner ensures you have those checks and balances throughout the process. And I'm sure Jennifer or Faith could elaborate on the cycle.
Go ahead, Jennifer.
Go ahead, Faith. Yeah.
Well, my view is kind of what I was talking about. The tough thing that I think the GSEs are probably going through 2020 and 2021 volumes. And here we are in 2022 with a lot less volume, but equally high scrutiny on those loans because they're purchased, because our processes keep redefining, because we're, coming out of a pandemic, but we did everything remote. We had lots of different rules of the road in the last couple of years, and then what we're doing today. So a little bit of slight chaos in the market. So to Clayton's question, I would say you're in a sandwich situation. You've got to keep funding your high quality control and risk management. Very hard for people to do in this environment, right? I want my revenue generations. I want more fee income. But I think it's a little bit risky. So you got to get smart, leverage your tools. I mean, it's probably cheaper than setting up a brand new department for, something that could be generating some risk. So it's just kind of operating smartly for the past, but also as you go forward.
Jennifer, anything you want to add to that?
Yeah, and I think, considering tools that are able to kind of, offer several things with one platform, right? So you're not having to go to disparate systems and do stare and compare types, lookups. So finding tools that can do those verifications, and you can integrate those different validation and verifications within that system is key too, because everything will be consistent and there's less room for error.
Yeah. We've talked about tech quite a bit throughout this conversation. A lot of tech still needs some manpower behind it. Can we dive a little bit into the human touch in the QC process? So finding out the balance between, as Faith just mentioned, there's still going to be a lot of scrutiny of these loans, the high volume, and even in this lower volume area. Where does the human element come into play in this discussion? And maybe Mike, I'd start with you.
I think I was just so the human element to me is around confidence in the process. So having confidence in a QC process is extremely important, and an accurate QC process is key. So again, you have experience. So when I look at this space, those that you have partners with more experience, the accuracy becomes key, and then it becomes vital to successfully manage and stabilize that loan quality risk and help build the resiliency for the market volatility we're going through today. So it's a partnership between confidence and accuracy that would build trust in the system. And when everybody has trust in the system and how it's working, you could see things. You could take on more chances, like new technology, and having that human touch allows you to have more technology further up and have the human checks and balances later on. So you don't have technology, checking technology like Skynet. So
yeah. And a good part of this discussion, I think, too, we're talking about all the benefits, how to maximize your tech stack, how to ensure that even if you have like, you're needing to prioritize different things, how to make sure you're prioritizing things that really help you with ensuring that your pipeline is strong. One thing I don't think we've touched on too much is when it comes to the reducing the cost of loan production. So reducing loan production cost. Margins is something everyone's paying very close attention to in this market, which also is part of the reason maybe everyone's looking so closely at making sure they're maximizing everything. So maybe starting with you, Jennifer, on is there potential to reduce loan cost? We could talk about it from the QC side, from the fraud side. No, your world heavily is in both, but maybe speaking to the fraud portion of it, what would you add in there when it comes to, hey, this is also hitting that idea of the bottom line?
Right. So I think that, there are a couple different ways of looking at that, both through expert models with full verifications and tools like we've been talking about, but there's also, kind of artificial intelligence models too that are very targeted, that may not do a full review or give all of the data or the supporting information for that particular transaction, but it can guide you and kind of create those swim lines up front and early, so you kind of know which ones need to kind of go into a certain swim lane that would require more scrutiny. So that's one way to kind of tackle that, the cost of producing a loan.
Yeah. Faith, anything to add there?
Well, yeah, that'll probably be a whole nother webinar. I think the whole end-to-end system should be so much more viable in a digitization, in a, the old adage of blockchain that's not mentioned as much anymore, but you get the concept. It's just like, we shouldn't have 100% of the private label markets, 100% of loans due diligence a few times and 3 appraisals on those because of the manufacturing chain. The GSEs have done a good job trying to help companies digitize, and I know people like QC Alley and First American are good partners to the GSEs who've led the space on doing better on data quality, on certainty, on tech-enabled solutions. They've even lifted rep and warrants. So the more we can push forward as an industry on both origination and servicing, and that includes the QC process to, digitize it, automate it, leverage those tools, the smart tools, that AI, and capture it, then the investor downstream doesn't have to hire a bunch of people to go look for bank statements when you already have locked up an asset report that's still, you can look at through a reissue key. You have just a key, you don't have data floating around. But you go back to the source and you get that source data, and that loan was closed in a golden way. And so that shouldn't be as hard as it is for us all to figure out. But so we have all of these great technology players, but it still is not an end-to-end process. And I hope before I retire from this business, we see more of that.
Yeah, that's a great point about something I've been talking a lot about, is that the full kind of life of the loan, to your point. But as we kind of reach the top of the hour, and before I kind of go through and we give our closing thoughts from each of you on what final thoughts you would want to bring to this discussion, I would love to maybe put my final question around this idea of, okay, we're now surprisingly almost to the end of August. We're about to enter a new year. We've focused a lot on what makes this market unique, but I would probably end with a forward-looking question, and maybe Faith, this would be a great one for you. As we look at 2023 and we kind of go into the future, is there any other things that you would maybe highlight about? We have catered so much of this discussion to the state of the market today, but are there any bigger or broader themes that you think people should be thinking about when they're looking at future-proofing their business well beyond even the state of the market, and creating a business and using technology for the long-term success that is cyclical proof, really?
Well, we've got to reduce the cost of origination, and we should not be spending $10,000 a loan to originate a mortgage. I mean, that is the first problem. That makes it less affordable for the broad spectrum of borrowers to borrow, because you have to somehow embed that into the costs that you have. We there's now a lot of great tech. I know some great companies out there that have tech that sits on top of disparate data sets. So it's no different than what we're talking about today. But if you think about the future, how can we make sure our originations and our servicing and our investors who look to this to make trading decisions, sale of MSRs, transfer of servicing, how could they be confident that that loan went through Fraud Guard or IncoCheck, or I'm sorry, QC Ally? And if that's true, how are we capturing that, tagging it? How are we bringing the right data elements to kind of track and have very meaningful monitoring of our business that's accurate? And that brings confidence to global investors. And it's not that audacious a goal. It's a goal we've had for decades. And so I think the more we can kind of look for end-to-end solutions and lack of disruption, and catch the bad actors up front prior to closing or prior to securitization, the better off we are as a housing market. That will bring down inefficient costs out of the system.
Great closing thoughts, I would say too. And maybe if you have anything to add to that, but we'll go ahead and kind of move into, I always love ending with kind of the same thoughts, question, which is, we've had such a great discussion today when it comes to fraud, risk, QC that we need to be paying attention to. We can go, Mike and then Jennifer and then Faith. Quick final thoughts that you'd want to leave listeners with and attendees with when it comes to this discussion.
I would just say we're in a unique time where a lot of people sacrificed during a pandemic that never happened before. They gave up holiday schedules. They were willing to work remote. They worked with family all around them. And now they're on the balance sheet as a cost to produce a loan. So people are saying, do I want a healthy balance sheet or do I want to remember the people that got me here? And it's going to be a struggle over the next couple of quarters on your identity. And just believe so much in trying to figure out how to go from fixed costs to variable costs. Now is the time to do it. We're in a cyclical process of identification, then feedback and action planning. And that leads to trust and integrity. And then it lowers the risk on the front end. So there is potential to reduce production costs, better selection of high risk and new products and audits, and reduce the risk associated with lending in today's market, which will translate to confidence and accuracy overall in the loan process. And we want to be here to help at a higher level, because you will have to deal with even items like data that Faith is saying, and you're going to need the human aspect to help you along the way.
Yeah. Jennifer?
And from a fraud and risk perspective, kind of like what Faith was saying earlier, what's old becomes new again. So remain vigilant, keep a watchful eye, look to your partners, speak to your data vendors, make sure that they are up to date on their analytics. They're using the freshest, most, robust data sets to really help you make a strong decision.
Yep. Great points. Then Faith, if you wanted to round us out.
I don't have a lot more to say. These guys have the most detailed products and services, and it's been a pleasure to be with both of you guys on this panel. And I just think it's a time. I'm an optimist. That's always how I am about this business. It is a tough time. We have to acknowledge that, right? It's a difficult market, and I think we'll get through it. And I think it's all about what are we looking for in 2023. And to your point, what can I adopt? Can I freshen up my workflow? Can I preserve some jobs? I think your point's a good one, Michael. Right people, right seats, tech. How are you, can you use someone in another area that can be quite helpful if they're no longer needed in the loan production side? So thank you for having me and certainly us here.
These lunch and learns are always my favorite. I think it's a great way to kind of wrap up a busy season. I like how Michael put it. He's like, put an exclamation point at the end of the week. That might be one of my new favorite sayings to use on a Friday. But of course, to just echo what Faith just said, Faith, Mike, Jennifer, really appreciate the three of you taking your time today at the end of the week to share what everyone needs to know when it comes to this very important topic. Like I said at the start of this conversation, we are very much in a growth mindset. People are working almost double time this season in order to keep their pipeline strong. But as you're growing so much, it's very important and critical to the health of your business to be thinking of everything that we discussed today. So as a recap on some of those housekeeping items, for anyone who wants to go back and look at this, or if they want to share it with the rest of their team, you can go to one, if you registered for this webinar, the Lunch and Learn, you'll get an email in your inbox with it on demand that you can click through, or go to housingwire.com. In our Knowledge Center, you'll also find the on-demand recording of it there as well. So you can listen to it, take notes as you need to, because as we've probably just covered through all of this, very important key critical metrics. So once again, Faith, Mike, Jennifer, thanks so much for joining me today.